Well, hello and welcome. Welcome to our wonderful world of offshore property investment. My name is Scott Picken. I'm the CEO of IPS, International Property Solutions, and I just wanted to share with you from our experience some of the most important things that you need to know about offshore property. Now, many people think that we're in the property business, but actually what we do is much bigger than property investment. My passion is to help you make intelligent choices about offshore investment so that you can get wealth preservation, a plan B, and peace of mind for you and your family. Now, I know that we wouldn't even be talking right now if offshore investment was not something that you were interested in. And so that is where we're going to delve. I'm going to share with you over 15 years experience of investing in international property myself. We've put together this executive briefing, which we're running and hosting through this webinar, on the most important, the 5 most dangerous trends facing South African citizens today. With an uncertain future, how can you have wealth preservation, growth, a plan B, and peace of mind with regards to you and your family's future? And this executive briefing is actually sponsored by International Property Solutions. Now, before we start, if you don't mind, I would like to share with you a little bit about my personal story. The reason I would just like to share with you my personal story is that I've actually 4 generations African. We came out to Africa in the early or the late 1900s, in the 1880s. And I absolutely love Africa. I'm absolutely passionate about Africa. But I'm also aware, having half my family having come from Zimbabwe, we had 3 farms in Zim. We've ended up losing them. And today is not about a scaremonger session, but today is about sharing with you my experiences. And there were just 2 stories that I wanted to share with you. The first one was my uncle, who's a very successful investor. He started his business in 1980 in Zimbabwe, and his client, he actually represented, he ran a stockbroking firm, and he represented the wealthiest client in Zimbabwe in the 80s. And that client actually sat down with him. He was young. He was 31 years old, and he sat down with him and said, listen, when you live in Africa, it's fantastic, but whatever you do, don't live with your money. And so at the age of 31, my uncle actually set up an offshore bank account, and although he earned a hell of a lot of money in Africa, he was always putting money overseas, always investing in foreign assets and foreign income. And unfortunately, we all know what happened to Zim in 2003. The business was booming and he was making a lot of money, but in 2003 he decided, his son's teacher kept changing every term and there were no dentists left in Harare, and so he decided to make the move to Australia, and he moved to Brisbane, and he was able to buy a house for cash, effectively retire in Oz. And sure, he doesn't necessarily have all the trappings and fantastic lifestyle that we have here in Africa, but he was able to live securely and not to worry about money. And that's really where the plan B and peace of mind comes in. I certainly followed a very similar. I absolutely love South Africa. I'm passionate about it, but in the back of my mind, I've always believed that it's important to have a plan B, to earn foreign currency in terms of wealth preservation, to build up and accumulate assets overseas. And really for me, that gives me the peace of mind. And so what I did is I actually went to London in 1999 at the age of 22. I bought my first house in London at the age of 24. I set up my first international business at the age of 26. And ultimately I've been investing in London and Australia and South Africa and over the last sort of, what it is now, 12 to 13 years, although I've been in the international property market now for well over 15 years. And really for me, what that does, both for my property, my offshore assets and income, and also my business that earns offshore assets and income, or creates an offshore asset and earns foreign currency, that for me really does provide those 3 criteria. Wealth preservation, so when I build my wealth in South Africa, I look to invest it overseas and to invest in first world assets and first world income so that I'm hedging against the rand. I also have a plan B. I've been here for centuries, well, not centuries, but certainly generations now. I think we're in our 5th generation in Africa. So I really hope that we're here for many more generations to come. But my attitude is not about being a scaremonger with regards to South Africa. If you'd invested all your money and had all your money tied up in American property in 2007, you wouldn't be feeling very clever right now. So I believe with the way the world's going, and globalization and globalization, it really provides a fantastic opportunity, and one needs to take advantage of overseas markets. But I'm a firm believer that there's great opportunity in Africa. There's great opportunity in South Africa. It's a lot easier to earn 15 Rand than it is to earn £1 or even 8 Rand than it is to earn $1 Australian. But I personally believe that it's very wise, it's very prudent to take some of that money and to invest it overseas and to be accumulating offshore assets and offshore income. And the way I see it, I'm basically hedging my bets both ways, because 20 years from now, South Africa could be booming. Fantastic. I've got offshore assets earning me offshore income. I do believe the Rand will continue to devalue over the long term, and it sets up beautiful passive income for me in the long term. My ultimate dream is to be able to live in Africa. I'm looking at the most magnificent view of the ocean with Table Mountain as the backdrop as we speak. And I really hope and pray that neither me nor my future generations need to leave. But either way, we are protected and we are covered. So that's really the story. That's the essence. That's where the passion comes from. That's my belief. And as I said to you, today is about educating you. Today is about teaching you. Today is about sharing the tricks, the tips, the skills, the strategies that I've learned in my 15-year journey as I set up that challenge and that plan B and that peace of mind for my family. Just before we get started, please pay full attention to the webinar. I know that when you're on the computer, you can tend to get distracted. Check your emails, check your Facebook. But you know, in life, if you do something, do it properly. You know, when you run onto the rugby field, you don't you're not worrying about other things. You're focusing on playing the game and winning the game. You know, when you're having dinner with your wife or your girlfriend or your husband or your boyfriend, you know, pay attention in terms of what you're doing, and you'll get the maximum out of that experience. Well, it's no different with this webinar. And if you want to get maximum out of this experience, pay full attention, react to the questions, and get involved. So without further ado, I'm about to share with you the pearls of wisdom. And most importantly, if you're interested in wealth preservation, a plan B, and peace of mind, then you've come to the right place. Let's get started. So, in all our years of experience, in over 15 years of experience, what we tended to find from all our high net worth, sophisticated investors that we deal with, and I'm sure that you are one of those people, we find that there's a number of reasons that they come to us. There's a number of reasons that they're looking to invest overseas. There's a number of concerns or worries that they have, particularly with regards to South Africa and where it's going in its future. So a couple of the reasons as to why people come in, and think about it. Which one is relevant to you? They're looking for investments and returns. So they're purely investors, and they're purely interested in the numbers and the returns, and they're interested in what other markets can offer in comparison with South Africa. They're looking at a Rand hedge. You know, at the end of the day, statistically, the Rand is devalued by 6.9% year on year for the last 20 years against the Australian dollar, and very similar numbers against the pound, the American dollar, and other international currencies. And that's what's happened over the last 20 years. Where do we perceive the Rand to be over the next 20 years? The third one is asset and wealth preservation. They're looking to accumulate first world assets. They're looking to preserve their wealth. They want to be able to buy assets with their rands now, so that in the future, should the rand devalue, they've still got assets that will retain their value, and they're not on a constant treadmill trying to earn more money to keep up should the rand devalue against foreign currencies. Because at the end of the day, we're all global citizens. We still want to go on international holidays. We still want to be part of the global economy. And it's very important, if you're wise and prudent, that you need to be able to stay akin with your fellow investors, your fellow businessmen and businesswomen around the world in terms of our buying capacity. The fourth one is risk diversification. This is an age-old principle, and really as the world opens up, you know, 10 or 15 years ago, to buy property if you lived in Joburg in Cape Town was a massive thing. But with the world changing, with access to information, now it's about getting the best return on your investment, and which markets can provide you that, and which markets can provide you the external factors that you are looking to achieve, basically. And as I said, you know, you can look at America. It's not just a South African thing. You know, if you invested all your money in American property in 2007, you would have looked a bit bloody stupid today. And similarly, I read research about 2 years ago, and the biggest investor in American stock exchange after the Americans, take a guess, who do you think it would be? It was the Australians. The Australians. So it's not just a South African thing. It's wise and prudent to look at international markets and to diversify. Then you've obviously got the fifth reason, which is the insurance policy, a plan B. You know, what happens? All of us hope and pray that we never have to leave South Africa or Africa. You know, I always think of that movie Blood Diamond, where he picks up the soil and he says, this is in our bones, it's in our body, it's who we are. You know, and I've lived overseas. I've lived in London for 9 years, and it's fun to go and see the world, but there's nothing like home. And one of the greatest decisions I ever made was coming home and living in South Africa, and I've been here now for 4 years after living in London, and I can honestly say it's the best thing I ever did. Maybe marrying my wife was the best thing, but anyway, but certainly coming home was. But as I said, I was comfortable to come home because I had a plan B. I had foreign income. I had a foreign company that was accumulating foreign assets, and that allowed me the peace of mind to be able to live in Africa and know that I didn't have all my eggs tied up, and certainly in terms of a plan B. Immigration, a lot of our clients come to us, they've made a decision that this isn't necessarily where they want to live, and certainly in many instances it's to do with their children, and that's fine. There's no right and there's no wrong in terms of what they're doing, but one of the major things that we educate people on is the benefits of property and how it can facilitate with your immigration. A lot of people aren't necessarily wanting to leave now, but are looking to plan over the next 5 years, and if you do it right, then property can be a huge enabler. But you also have to be very careful. There's a number of countries out there that say that you get a passport, and there's no free ride in the world. And if you get a passport with your property, then you really need to systematically look at the investment and how good that investment actually is. Because generally you'll find, and I've looked at them in Mauritius, in Cyprus, in Malta, in America, and this is all in our investment reports if you want to read them. But all of those markets, you know, you're buying a property, but at the end of the day, the property is not the investment. You're getting the passport. And there's certainly been a huge amount of problems in America and Malta. They just changed the rules, and now suddenly people have properties in Mauritius. You buy the property, but the moment you sell it, you lose your citizenship. So I'm a far bigger believer in becoming a global citizen, in accumulating assets and income in foreign currencies, so that you can be like my uncle. Should you want to move, you can buy your way in anywhere. You can invest, and ultimately you can move wherever you want. You're a global citizen. You can live wherever you want, and by enabling that, you're not only going to live a fantastic life for yourself, but you're providing your children with a fantastic opportunity. So that's a very important one as well. The next one is long-term investment. Should I move one day? So again, this isn't necessarily, you know, where I am now. I'm not making any decisions, but certainly I know that I'm very comfortable knowing that I own offshore investments. You know, should I move one day, I've got first world assets and first world income. Then peace of mind, you know, knowing I have options for my family and myself, no matter what the future holds. You know, in life, I don't believe that gambling is the right thing to do. You know, Clem Sant is a fantastic scenario planner. There's a new book out by Jim Collins, which, you know, he's the guy that wrote Good to Great, and his latest book that's come out is all about planning to fail. And he says the greatest entrepreneurs and the greatest businessmen actually plan to fail. And what they mean by that is they go into business, they obviously have a vision and they see the upside, but they also plan to fail should the business not work, or should the investment not work. And that for me is what peace of mind is. You know, in terms of our future, why bet everything on one scenario? Why not have a plan for both scenarios? And that provides you with peace of mind, and it provides your family with peace of mind that there is a solution no matter what happens. And then lastly, as a bit of a joke, but many people certainly over the last couple of years have come to us because of Malema proofing. You know, they don't like what the man's saying. They're worried about the situation, and I know it's very encouraging what happened in November, December of 2011, where the ANC certainly seems to be getting more control over what he's saying and how he's doing it. But what concerns me is that there's still 10 million unemployed people in South Africa, and whether it's Malema or the next person that arrives, you know, there's still a massive problem of 10 million unemployed people, and with one man, one vote, you know, at the end of the day, you've got majority rule. And just like happened in Zim, in the early 90s, there was actually a war vet who came out and started saying, you know, take the land, and the government said, no, that's never going to happen, etc., etc. Well, unfortunately, we all know how that played out over the next 10 years. And so, you know, where there's smoke, there's fire. And again, I'm not a doom-monger at all. But for me and my family, I like to have a plan either way, depending on what is going to happen. So what are the 5 greatest risks that I believe that we are actually living with as South Africans here in South Africa? The first one is extremely high stress. We've got political and economic instability, we've got currency devaluation, we've got wealth preservation, and then we've got the fact that over 80% of people that invest overseas actually lose money. So even though we've got all these other problems, and most people are looking for wealth preservation, a plan B, and peace of mind when they invest overseas, more than 80% of people actually lose money. And the whole purpose of this webinar is to teach you, to train you, to show you with 15 years of experience how you can be in the top 20% that not only make money but achieve wealth preservation, a plan B, and peace of mind. So let's look at them. 3 out of 4 adults in South Africa are concerned about their future because of political and economic instability and the fact that 96% of South Africans will not have enough money when they retire. And that actually came from the Financial Mail in April 2010. I'm not going to hop on about crime, but at the end of the day, I've just moved from Johannesburg down to Cape Town. It's definitely a more chilled way of life, but we do live with intensity. We're concerned for our security and for our families. We choose to live in this wonderful land, but it is something that certainly is out there, and it just adds to the stress level that we all have to deal with in terms of where we are, not only for ourselves but also for our children. The second one, again, I'm not going to go into in too much detail because we're all aware of where we are, but it's the political and economic instability. The fact that we're a one-party state. As I said to you, I've just moved to the Western Cape, and it's amazing down in Cape Town. Everything just seems to work so much better than it did in Johannesburg. I've never seen one robot that has actually been out. And interestingly enough, the ANC is now talking about making it a one government state, so we wouldn't have the provincial governments, which would get rid of the DA. And I was debating with my friends over lunch the other day, and they said, well, that never happen. And one of my friends turned around and said, at the end of the day, they've got a 66% rule. They just need 1 or 2 more percent, and they'd be able to push that through. So these things are a concern. We've discussed Julius Malema. I think whether or not he's out the picture, I'm not convinced myself, but I certainly am very encouraged by what the ANC have done. But what worries me is whether it's Julius Malema or another person that rises up behind him, there's certainly a huge amount of people that are willing to listen to the populist vote. The xenophobia that happened just after I got back from London in 2008, and it continues to breed here. And the thing that's so tragic is the lack of respect for human life in terms of what's happening. The infrastructure problems, we know what happened in 2008 with Eskom, and it's interesting, it seems to be abated itself, but we know that we're riding a very thin line. You only have to watch ETV or any of the TV channels, and they're constantly telling us that there are challenges. So, and I think the infrastructure, particularly when I go to Joburg regularly on business, the robots being out, the potholes, etc., it is a concern. At a macro level, I deal with a lot of high net worth people who are in very affluent positions, and the challenge is it's worrying where it's going. It's worrying what's happening with all the different systems, the education system, etc., etc. And that brings us on to the fifth part. My mom is actually a teacher, and I get all this information and what is happening. And there was actually an article last week in the newspaper. Over 90% of children in grade 2, grade 4, grade 8, and grade 10, weren't able to pass a maths test. And I mean, that's seriously worrying because, countries advance because of maths and science. And it's really concerning the education and what's coming through. And Clem Santa actually spoke about it. There's only 5,000 top quality schools in this country out of 30,000. And really what's going to be interesting is do we try and pull up the 25,000 to join the 5,000, or do we pull the 5,000 down? And obviously that's a big concern for all of us, particularly with children. I've got my first child on the way in April, so these are things that I need to take into account in terms of where we are. Corruption, I think that goes without saying in terms of what's happening, and again, it's a massive concern, and hopefully the ANC and the government can get on top of that. There's a lot of talk about the nationalization. There was an article in the newspaper yesterday about the huge drop in international investment, primarily in the mining sector over the last 5 years, because of the constant talk about nationalization. And it was very much similar to when I was in London and we were promoting South African property in London to both the expats, the British and the Irish. And although nothing ever happened about it, they constantly talked about how they were going to stop foreigners buying South African land. And although nothing ever happened about it, it was a constant problem, because it's hard, when you live in South Africa, you don't think it's a big issue, but when you're overseas, you're not sure what's happening. You hear these talks and people saying things, and at the end of the day, when you're weighing up options, and you could invest in Australia in a mine, or you could invest in South Africa, it just gives them peace of mind to be able to go and invest there, or possibly even other places in Africa or South America, and that's a massive problem, and then the secrecy bill, and what's just happened with that just prior to Christmas. Interestingly enough, I've got another presentation which is actually by Clem Sunter, and I would highly recommend that you go and you go and view it basically. And sorry, let me just where's it gone now? Here it is here. So this is a presentation by Clem Sunter. I've been a number of times to watch Clem Sunter. He's the leading scenario planner worldwide. We're very proud to have him from South Africa. He's the ex-chairman of Anglo American. And what he does, he's got a fantastic talk where he gives scenarios on where the world is going and where South Africa is going. He talks about the high road and the low road. And very interestingly enough, he came up with 4 flags. At the end of the day, we're in the Premier Division at the moment, which is the top 50 countries in the world, but he gave us 4 flags as to what will cause us to drop into the secondary division. And I last went to his talk in July 2011, and the 4 flags were nationalization, so nationalizing the mines and how that would happen, and he explained how it's never happened successfully around the world. Then the clumsy implementation of the health policy, again, where doctors and nurses are forced to work under an NHI system similar to in England. And interestingly enough, my brother's a doctor, and he's looked into it and pretty much said to me that if it comes in its current form, he'll have to pack his bags and be leaving, because there's no point in being a doctor and specializing and going through everything and then being told what you can and can't earn. The media tribunal, the secrecy bill, and then the land grabs. He pretty much said if we get to land grabs, it'll ultimately lead to civil war. He said, the Afrikaner community has fought for land in many wars, and he doesn't see people in this country just giving up land, willy-nilly without quite a serious fight. Now, I would highly recommend you go and watch that whole webinar. I'm not going to go into it in a lot of detail, but the concerning thing is that all 4 of those flags are very much up there. The secrecy bill, has pretty much been approved. Nationalization, there's a lot of talk on it. The ANC are actually doing a review on it at the moment. It seems like the national health thing is going to happen no matter what. And ultimately, where do we go with regards to land and everything else? So it's certainly, the 4 flags are certainly flying. And just like Clem Sunter says, if you're swimming at the beach and you've got the red flag, you know where to swim between the things. But if a black flag comes out, it's a shock, and you need to get the hell out the water very quickly. And what I love with his scenario planning is that we need to be able to judge what's happening, and we've got to watch the flags, and then based on the flags we've got to make decisions about ourselves and our family. And so it's very important, and I would highly recommend watching that webinar, because I've actually scientifically shown you based on the scenarios where one should be investing, how one can be investing, what happens with the different scenarios globally, what happens with the different scenarios in South Africa, and what impact that would have to us as South Africans who are looking to invest both locally and possibly overseas. And most importantly, like I've said all along, I like to have a plan no matter what scenario plays out in terms of where we are. And here's our good old friend Julius Malema and his constant comments and things, and this was about was on Twitter, and what he was saying about Walmart in terms of where we are. The third one is currency devaluation. Now, the economic fundamentals, let's forget about anything but other than economic fundamentals. South Africa's 10-year inflation is 9%. Okay, it's currently 6.5%. Australia, as an example, 10-year inflation is 6%, and it's currently 3%. While we've got a 3 to 5% gap in that inflation, it is scientifically, it's economically proven that the rand will continue to devalue, because you can't have inflation higher in one country and lower in the other country and expect the currencies to remain in equilibrium. So that's economic fact. The second thing is the OECD said that the rand is overvalued and that it's hampering growth. Zuma came out late last year and said that need to consider what is best for the country. And we know that there's political interference with regards to the devaluation of the rand. One of the biggest job creations in this country is both agriculture and mining. Both of them are very labor intensive. Both of them rely on a weaker rand so that we can be competitive internationally. And so there certainly is manipulation. I know personally, I moved a lot of money. I moved nearly 2 million rand over to England at the back end of 2009, thinking I was very, very clever. It was a good time, and I thought the rand was very strong at 12 rand to the pound, and that it would devalue Actually what happened was that the government opened up the lending or the ability to send money overseas, and immediately overnight the rand devalued quite dramatically, and that money was sitting overseas and I couldn't bring it back. So there certainly is manipulation in terms of what's happening. COSATU and the exporters are consistently asking for a decrease in the rand, and then because we're quite a small currency, it's one of the most heavily traded currencies in the world, but we're no different than a little corkscrew bouncing on top of the ocean, and someone like George Soros can just short the rand like he did in 2001, 2002, and we all know what happened there. It went from 10 or 11 rand to the pound to 20 rand to the pound in the space of 2 weeks, and a lot of people lost a lot of money because they panicked, got their money out at ridiculously bad exchange rates. And that really, my mother did it, funny enough, and I did the opposite. Because I was earning pounds, I came back to South Africa and accumulated assets at a fantastic rate. So that's really, for me, is part of that planning and peace of mind. And then some research that I did actually about 2 years ago. Do you know that 90% of people in the middle and upper class in Zimbabwe, Argentina and Russia were directly affected financially by currency fluctuations? So you've got to have first world assets and first world income so that your life is not dependent on what is going to happen with the rand. And the rand is not something we can predict. No one is an expert. No one knows where it's going to go. But I tell you what, you can look at long-term trends. Robert Kiyosaki, in his book Conspiracy of the Rich, said one of the easiest ways to get wealthy is to look at long-term trends. And let me just show you what I mean in terms of these long-term trends, because I don't know what's going to happen with the rand in the next year or two, but I've got a very strong feeling on what's going to happen over the next 5 to 10 years, 20 or 30 years. This is some more research that I did. I took house prices in Australia and South Africa. I've done the same research for London, and it shows very similar results. And I went as far back as research could go, which was 1978. If you'd invested the exact same amount of money in South Africa and Australia, the exact same amount of money in 1978, do you know that according to this graph here, the red line is the ABSA housing index, and today you would have roughly R1 million worth of net asset value. If you'd invested in Australia, you would have roughly over 3.5 million rands worth of net asset value. That's a 350% difference, or 3.5 times more. If you'd invested the exact same amount of money, this is statistical. You cannot fight this. These are the exact numbers based over the last 32 years. If you invested the exact same amount of money in South Africa and the exact same amount of money in Australia 32 years ago, that is the difference in terms of where you would actually be. And my question to you is, where do you think we'll be in 10 years from now? Where do you think we'll be in 20 years from now? What do you think this graph will look like in 32 years from now? So basically, what is 32 years? 2054. Once your children are taking control of their lives, where do you think, and what do you think it'll be over the next 32 years? Now, interestingly enough, I follow a lot of research, and this company has been around since 2002. If you are interested, get hold of me and I can send you the reports. But since 2002, they've been accurate. They test the probability of the rand on where it's actually going, and this particular graph is against the US dollar. And over the last since 2002, so over the last 10 years, they have an accuracy rating of more than 80% of tracking the probability of where the rand's going. So I certainly think it's something that we should follow. I don't think anyone has a crystal ball, but probability is certainly something that one needs to take into account. And the very interesting thing, if they take their 5-year projection, the rand is currently about 8 rand to the US dollar, and interestingly enough, when they do their scenario planning, there's no arrows saying that the rand is going to strengthen. The only thing that they're not sure over the next 5 years is whether the rand is going to be 11 rand to the US dollar or 22 rand to the US dollar. So they don't think it's going to strengthen from where it is today. They're just not sure how much it's going to devalue by. And that again is long-term trends. So for me, currency devaluation is something that is robbing us of our wealth. Because if I've got 10 rand and I put it in a bank, if currency devalues, it's robbing me of my wealth as a global citizen in terms of my global buying power on the international markets in terms of what's happening. The fourth one is wealth preservation. And the big thing that really concerns me here is that a lot of people are not aware of what is necessarily happening. You know, the right to land transfer and land ownership is inextricably linked to human dignity. As early as the 5th century, property has determined whether individuals were slaves or freemen, and we all know of the monarchs and how they used to own huge amounts of land. Since the 16th century, property still, by and large, determines the extent to which an individual's inheritance dignity is respected and protected. The problem in South Africa is that we've got a shameful history of disposition and institutional restrictions on black ownership, from about as early as the 20th century. Now, I know when the new government came into power in 1994, over 95% of all the land was owned by 5% of the population. So I'm not saying that we don't need to rectify that, because if we don't rectify it, there's no ways that we can have a sustainable and happy future in this country. My concern is the way that it's actually happening. As a result of history, the question of land reform has not only had economic significance, but it's had massive political emotions. And this is why the protection of property is arguably one of the most contentious issues that was negotiated when they came up with the final constitution between 1992 and 1994. And just a matter of interest, all this is actually from the Center for Constitutional Rights, and if you're interested, I can send you the full paper. I've just taken out the points that are important. In marked contrast to Zimbabwe, government chose not to use wholesale expropriation without compensation as the main vehicle for land reform. Instead, it adopted a reform program that served to increase business confidence both domestically and internationally, which in turn enabled to meet its economic goals. And I think we can all applaud the government for what they've achieved over the last, well, it's 18 years now since independence, and really, it's really powerful what has happened. But sadly, because of the slow pace of the distribution, they're now looking at changing their land reform goals, and there's a lot of pressure on governments and service delivery and everything else. And what's very concerning is that this is the way that it played out in Zim. Now, Zim is nowhere near like South Africa. South Africa is so much bigger as a country, but this is what happened. You know, at the end of the day, when government was delivering, the people, the voices, the political interference got louder and louder and louder. So rather than examining the reasons for the slow delivery, basically, and the institutional shortcomings as to why the government is not actually, changing its policy and bringing, more delivery of land and houses and what they're looking at, that rather than government intervention, they should look at a less market-related approach. But doing this, it's going to have a disastrous effect on the economy as a whole in terms of what they're looking at. The first indicator of this change came as the release of the government's draft agri-bill framework, which dramatically increased the targets for distribution and black economic empowerment. The second indicator came with the release of a report by the government-appointed commission into the issue of foreign ownership, which completely negates the government's policy on foreign investment. The last development, and the most overt, is the release of a draft policy document on the principles which should underpin an amended expropriation bill. Now, I've put the important things here in red. But the first of these is to move from an existing use of expropriation, which is essentially for public purposes such as roads and parks, and instead to use it as the main vehicle for redistribution, coupled with an unconstitutional hierarchical rankings of various rights manifested in other major shifts. Land reform and redistribution are elevated to the primary consideration, whilst property rights contained in 25 of the constitutional in 25 sections of the Constitution are relegated to a secondary level. The right to lawful, reasonable and procedurally fair administration action limps in at a weak third. The next important change is a move from existing fair administrative procedure to executive diktat. The new procedure envisaged commences with the identification of land for redistribution, followed by a notice of expropriation. After the expropriation of where the authority takes ownership, can you only talk about the question of compensation. So you've already lost the land, and only then can you talk about, the question of compensation. And this is the most important thing, because the last important change is the move from the courts as the final determinant of the amount to be compensated, which is based on the current market-related value of the primary land or determinant, to an arbitrary executive determination, which would only be subject to review by a court and not appeal. And again, this is all for the Center for Constitutional Rights. So what will the consequences be if this land reform policy is to be agreed upon? Firstly, by enforcing landowners to accept less than market-related price, the state will effectively have shifted its constitutional burden of bearing the costs of land reform to individual landowners. Secondly, it will negatively impact on the property market as a whole, as no one would want to invest in property which is subject to arbitrary expropriation with less than market-related compensation. You know, it'll probably start with farming land, but how can one say that it won't happen to an office park or a shopping center? Thirdly, it will threaten the stability of the agricultural industry, as neither emerging farmers nor existing farmers would be able to access funds without the security of collateral, namely the land. So the bank won't lend against the land because they can't, be sure that you will be able to retain that land, for perpetuity. Fourthly, it'll undermine the cooperation between the agricultural sector and the government, which is essentially for sustainable land redistribution and agricultural productivity. And we know what happened in Zim. Basically when they took this away, all the farmers left and the country starved. And that is where you get the massive instability in the country. And lastly, it would undermine investor confidence, both local and international, with dire economic consequences. And again, these are the concerns of the Center for Constitutional Rights. Security of land tenure and market-basis land redistribution model are the cornerstones of a free economy and essentially to the future economic well-being of the country. One need only look to Zimbabwe to see the resultant deleterious effect that tampering with these had on the economy. And this whole report is done by Nikki de Havilland at the Center for Constitutional Rights, and I would highly recommend you go and look at it. But the problem is that most South Africans are not aware that this is actually happening. And so we need to be aware. We can't be ostriches and stick our head in the sand. We need to be aware of what's happening, because this has a massive impact on our wealth. If we've got all our assets, tied up in South Africa, tied up in property, tied up in investments, if this was to change, you can imagine what impact it would have on the property market, what impact it would have on the stock market, what impact it would have on foreign investment. And so to preserve our wealth, we have to be aware of these things, and we have to plan and have scenarios no matter what happens in terms of where the market goes. And I wanted to again, I'm very, very chuffed with what's happened with the ANC and the way that they have behaved with Julius Malema. But this is exactly a recording of Julius Malema at the very last ANC Youth League conference at the end of last year. And this was his thoughts with regards to land tenure and what should happen. And what worries me is, even if they nullify and get rid of Julius Malema for the next 5 years, with 10 million unemployed young people in this country, this is their opinion, because they are the populist vote, and this is what they like to hear.
And the first one deals with expropriation without compensation. We're talking about the taking over of the land by the state without compensation. And we're saying this should be done through the introduction of laws and legislations which will give the democratic state powers to do so. Now, this taking over of the land without compensation is informed by the fact that when they took over our land, those who are owning it today, they never gave anybody compensation. And therefore it will be incorrect to want to demand that they must get anything from us. The other issue is that we have no enough money to buy this land from these people. And if we take the little money we have and go and buy the land, we run a risk of failing very important service delivery issues like free quality education, healthcare, housing, electricity, sanitation, and water. We are here trying to address a problem that was created for us by the colonizer. And therefore, we cannot be persuaded otherwise, because we feel very strong that we need to reverse this crisis caused by the colonizer. Now, we all agree that those who have taken the land from us are now part of us, and therefore it is important to share equally with them.
So there you'll see, you know, and I could go on, but the essence of it is I don't like to hear that, and I'm not necessarily saying it's going to happen, but just like he said with the populist vote and service delivery and electricity and water and one man, one vote in this country, the challenge that we have is that it is a risk, and whether we like it or not, it's a risk we need to be aware of. And so my logic with regards to planning for my future, for me and for my family, is that it's a risk, it's out there, and I believe that you've got to have a plan should it take place. Maybe the chances are 1%, but if they do, it will have catastrophic effects on this country. And my question is, if you go to a casino and you bet all your money on red or black, what happens if it lands on green when you're playing roulette? You know, are you prepared to invest, or are you prepared to gamble your entire future on the fact that this doesn't happen? And one thing that I've certainly learned, both in the property market and in the economic world, is where there's smoke, there's fire, and one needs to plan. We all learned that with the global financial crisis. One needs to plan no matter what scenario takes place. But the challenge that we've got, and the fifth major dangerous trend, is that when people actually invest overseas, there was a report that came out in 2011 that over 80% of people that invest overseas, both in the property market and the stock market, actually lose money. So even though they've got all these concerns and they want to put their money overseas, they actually lose money. Well, my opinion of why people lose money is, the first one is they make crisis investments, both with currency and with assets. And the reason is that if you take 2001, and you use my mother as an example, she had a whole lot of money here, and she tried to move it over to England. She panicked. The rand had devalued because of George Soros, and rather than getting 10, 11 or 12 rand to the pound at the time, she got 19 rand to the pound. Now we all know that played out, and in a year it had recovered, but the bottom line is she sent her money out at 19 rand to the pound, and with it currently sitting at 12.50, you know, she's got a hell of a long way to recover, no matter, even if she put the money in the bank, you know, to get her money back. So, and the other thing is, when it comes to shares, and even worse with property, is that people make crisis investments. They think to themselves, right, I need to buy a house overseas, or I need to buy a property. So they jump on an airplane, they fly to London, or they fly to Sydney, and they're there for a week, and they think to themselves, oh, you know, I'm going to buy a property, and they're under pressure. They've got 1 week. They don't understand the markets. They've got a gut feel in South Africa. They might have been very successful in South Africa, but they put themselves under pressure. And I always say to someone, you know, if you didn't know Cape Town, if you lived in Johannesburg and you came down here for a week, what would be the chances of finding a great investment? And anyone with any intelligence would realize that it's very, very small. And so by making those crisis investments, that is how they lose money. And I think one of the most important things that we recommend people to do is to make strategic investments, to plan for the future, so that no matter what happens, no matter what scenario pans out, you have a plan in place. The second reason is they don't get the right information. They fly over, they meet with people on the ground, estate agents whose vested interest is to sell them something, or they even meet with people in South Africa here whose vested interest is just to sell them something. They don't get the right information. They invest in a place like Dubai or Manchester, and they're told, you know, on the brochure it all looks good and the rentals look good and everything else, but they don't actually find out that in Manchester there's over 2,000 apartments standing empty, and they were told that students were going to rent them, but they don't find out that they're 15 or 20 k's from the university, and students don't like to live that far away, and so they get left with apartments that they can't rent out. Or in Dubai, where there was massive oversupply, or one of my trips to America where there was actually a launch here in South Africa, and it looked really good on paper, but I took the time and the effort to fly over, and with my experience I was able to ask the questions, and I realized that they were selling a complete lemon here in South Africa. So it's all about finding out the right information and what's happening. Then they go with the wrong partners. They go with people that don't specialize in international investment. You know, it's one thing for an estate agent to be fantastic at selling you a house in the suburb near where you live, but it's a whole nother ballgame to invest overseas. And, you know, it's a specialist niche, and you need to deal with people that specialize in that niche. And it's why it has become offshore investment is a passion of mine, and it's become an expertise of not only myself but my team and my company. And we specialize in offshore investment so that we can help people do it right, and not only understand the upside but also understand the risks and the pitfalls in terms of what is happening so that they can go about it. They don't understand the cash flows or the management. It all looks so good in the brochure, but they don't understand all the hidden costs, and most importantly the management. Who's going to manage the property? Because with property, if you don't have a tenant, the whole thing falls over basically, whether it's residential, commercial or industrial. And a lot of people, they get made a lot of promises, particularly with management, and then there is no solution. And we've heard catastrophic examples in Ireland, in Dubai, in America, and in smaller markets like Mauritius and Cyprus, where people were made huge promises, and some of the eastern states like Hungary, Malta, where they made huge promises, but unfortunately there's nothing to back up those promises, and people are left with their properties standing empty, and the whole model falls over. They work with companies without local and international offices. One of the big problems we always have is clients come to us and they bought something off an estate agent out of a hotel room, and it's just an estate agent who flies over here for a week with the intention of selling whatever they can, and then they can't get hold of them. They've got no back office, no system. And I always say it's vital to work with companies that have offices in both jurisdictions. If you want to come to South Africa and deal with me or my team, you can come find us. Come beat us with a baseball bat. We South Africans, our name and our integrity is vital in this market. And I've learned this from English people. They come out here, they sell crap, and they go overseas, and they don't care, because next time they'll just go and sell it in Singapore. But it's about your integrity and about your name. It's about your delivery and your long-term trends in terms of what is actually happening. So you've got to ask, and more than 80% of property that is sold in this country is sold by companies from overseas who fly in and fly out. And I ask the question, is there any correlation between the 80% of companies that come and do that and the 80% of people that actually lose money? People underestimate the sales and the costs. There's a lot of extra costs that are involved, and the after sale, managing the whole process, getting the mortgage. So understanding that after sales process, and again, most estate agents will be good at selling you something, but they don't understand the process. They don't have an after sales department. We have a specific department, a private banking solution that helps you with that after sales. And it's really, really important, that whoever you deal with has that level of expertise, that has been in the market, understands the different countries, because there's huge nuances that are different between each country, and you need to understand it and the costs, because otherwise you will lose money. And the last one is one that we've unfortunately learned the hard way, both personally and with our clients over the last 2 years, where if you buy off plan in countries like Australia and in England, the bank will only give you 6 months pre-approval. So if you buy off plan with a year or 2 year for a project to transfer, even though that we actually got them pre-approvals, they don't stand like they do in South Africa until the property actually transfers. And what happened in England was that people got pre-approvals, but then with the global financial crisis, the rules completely changed, and the banks turned around and said they're no longer lending. And some of our clients, and personally it affected me as well, was that even though we were promised finance, and even though our circumstances hadn't changed, the bank circumstances had changed. And so if you are buying off plan, one has to be very, very, very sure in terms of, and you have to understand the risks, and you have to understand that if you don't get financing in a year or two, that you are liable, and you can actually lose your 10% deposit. And even though I've never seen it happen, the developers also threaten that they can sue you for the difference. So I'm very, very wary of off-plan developments, particularly with regards to these financing risks in terms of where you are. Now, just in my interest, people always have the debate between property and the stock market. This was actually some research done by Barclays Capital. It took from 2000 to 2010 the high net worth assets of all their high net worth individuals at Barclays Capital. That's like a private bank, like Investec. And it took all their assets and it tracked them over 10 years. And that included a stock market boom and bust. It also included a property market boom and bust. And interestingly enough, over the 10 years, gold came out as the top performer at 323, oil at 214%, fine wine at 178%, and property at 109%. Shares were minus 14%. But the thing that I find very interesting is that 109% for property is cash property. So if you understand the principles of gearing, depending if you gear at 75% or even less, even at 50%, then you would understand that the returns would become a lot more significant. And actually at 75% gearing or even 70% gearing, property would have been the best performing asset over the last 10 years. And again, that's based on long-term trends and research done by Barclays Capital and all their high net worth individuals and all their their assets that they have around the world. So I think it's a very good piece of research to be able to look at what's happened over the last 10 years in terms of trends. People always ask me what's the difference between investing locally versus offshore, and I put a little graph together here to understand it. If you invest locally, you generally will get a higher return, a rand return, and I think it's very important that you need to compare apples with apples, and that's why we have significant cash flows that we can show you. But generally, you'll get a lower return in US dollars or Aussie dollars or pounds, but again, you must be very careful to compare apples with apples. It's a lot easier to invest locally than it is to invest offshore. Again, you don't know the market, you don't have the information, your gut doesn't work, and you don't have the partners. Your peace of mind, my logic is in South Africa, do I have the peace of mind? Well, again, there's two levels for me why I say no to peace of mind. Firstly, your right to property ownership is definitely hampered here in South Africa. I've got a number of property investments, and particularly in the residential sector, the police, the law is all in the favor of the tenant, and if someone doesn't pay you, it's almost impossible to get them out. I recently had a problem where we were trying to evict a tenant and the cops came to arrest my brother 3 times. In the end of the day, he owns the property. So does it provide me with peace of mind? Not necessarily, and also I've spoken about some of the political and economic instability. Whereas overseas, your property ownership rights are 100% protected. And you're pretty confident as long as you're investing in a first world country. It's one of the things that I do believe. I don't understand why people take their money out of South Africa and go and invest in another emerging economy. At the end of the day, there's great opportunity here in South Africa. There's huge opportunity for growth and to make money. And I believe when you take some of your money overseas, you should invest in a first world economy with first world assets, first world income, where the risk is lower, so that most importantly, you can bank on that wealth preservation in terms of where you are. So I think it amazes me that people take money out and go and invest in another emerging market where there's as much risk and a lot more risk because they don't understand the market and it's further away from them. Financial planning, well, look, investing in property is good for your family, but again, there are risks, and I believe you've got to balance it with offshore investments, offshore assets and income, and that's why I said yes. The rand hedge, well, obviously no for locally and yes for offshore, and diversification, no for locally and yes for offshore. And I've already used the story of the Americans. You really wouldn't want to have all your assets tied up in American property in 2007 because you'd be looking a bit clever. So this is not a South African thing, it's an international thing in terms of diversification. The financial advantages of international property, well, the first one is wealth preservation. The second one is a rand hedge. The third one is you get first world income and assets. The fourth one is tax. And I'm going to go into that in more detail, but if you can use property to be very tax efficient. The fifth one is you can actually build up an international credit rating, so you can build a credit rating in a foreign country, and I'll go into that in more detail. You get diversification and you get peace of mind. And interestingly enough, here on the right hand side, it's not all about capital growth. I looked at yield from 1978, again as far back as statistics went, and if you were getting the exact same return in 1978, today the blue line would be your South African return and the red line would be your Australian return. And you can see there that that's 180,000 rand per month, and this would be 80,000 rand per month. So it's more than double in terms of yield if you'd invested overseas. So again, whether it's capital growth or income and yield, the long-term trends are certainly in the favor of having some of your wealth invested overseas. Some of the other advantages are it provides you with a plan B, an insurance policy that allows for both scenarios. It provides you with possible immigration options should you look at it, and the most importantly, it provides you comparable returns, but they're in a first world economy. And we had a client recently that was trying to compare apples with apples, and that's why the cash flow is so important. But at the end of the day, you've got to compare. If you had R1 million and you invested it in Johannesburg, or you had R1 million you invested in Sydney, you've got to compare apples with apples over the long term. And by investing overseas, you're getting comparable returns with what you can get here in South Africa, but it's in first world assets. The question for me is, why invest overseas now? Well, one of the things is, with the global financial crisis over the last 3 years, there's low asset values. A number of markets around the world have actually lost capital growth or capital values, and so you're getting low asset values. The rand, it fluctuates up and down, but it is strong, and at the moment, and you can buy great assets with the strong rand. And if anyone disagrees with me, you only have to look at the biggest property funds in South Africa, the Redefines and those guys that are actually out there using their South African rands to buy international assets in both the UK and in Australia and in Europe, basically. And I think that, for me, is one of the the most important things, is that you look at the biggest property funds, and they're doing it at the moment, but they're doing number 3. They're doing strategic investment approach rather than crisis management. So they're not rushing into anything, but they know at the moment that there's low asset values. They've got a strong rand. They can go out there, they can accumulate great assets in terms of where they actually are. And so the biggest property funds, the listed property funds in this country, are out there accumulating assets in the first world economies. And that is why I'm doing it, and why I believe it's so important for you and as a high net worth sophisticated investor to be doing it as well. The other thing is that we can't control the variables. We don't know where the rand is going to be in the next year or two. And so something that one of the CEOs from Growth Point actually came out when they were asked why, which is interesting enough, the biggest listed property fund in South Africa. And they said, why are you investing now? And he said, well, there's low asset values, we've got a strong rand, and most importantly, we can control the variables now. We don't know where the rand is going to be in 3 years' time. We don't know where the property market's going to be. So if we can buy solid, stable investments where we know what the future is, we know that we've got protection of income, etc., then we can control the variables now. So don't try and think where the world's going to be in a year or 2 years or 5 years, because none of us know. But if you find a good property investment now that suits your requirements, then you can control investments, you know what you're getting into, and you can have a plan for your future. There's great opportunities for capital needing to unlock potential, and that's why the biggest property funds, the Growth Points, the Redefines, they've actually gone out. A number of the biggest property funds overseas got themselves into trouble, and they had to sell off their blue chip assets. What actually happened was their gearing levels got high, their loan to value ratios got out of control, and so what happened is these property funds, the banks came back to them and said they need to recapitalize their property funds, and the only way to do it was to sell their best assets, because they're the ones that had the most equity in them. And because of that, the biggest property funds from South Africa have been able to go overseas and to buy fantastic opportunities. But also, Joe Soap, the one-man investor, has the same opportunity, because for us, in overseas, it's very difficult to get financing, and for us, the financing rules haven't changed dramatically in terms of the loan-to-value ratios. So if we've got the capital, we can go in and we can take significant advantage of the opportunities which are available. And lastly, with our foreign direct investment and personal allowances having changed, we used to only be able to take, a couple of years ago, 500,000 rand out as your lifetime. Now you can take out 4 million rand a year, and if you and your wife and if you've got 3 kids over 18, you can take out 20 million rand a year. It's a significant amount of money. It really has opened the door and allows you to invest in whatever you want, and you can also use your foreign direct investment through your business to externalize up to 500 million rand. So really there's no cap anymore in terms of what is possible in terms of foreign investment and foreign ownership. And this is just a fun graph, but long term I believe that the rand is going to continue to devalue, and if you're buying the right assets, coming off a low base from the global financial crisis, over time the value of the asset is going to increase, and the longer you leave it, the more your problem, more that gap is going to grow. And that is, I believe, one of the biggest significant challenges for South Africans, is the devaluation of the rand and the increase of value. And as that gap widens over here, we've got a significant problem in terms of being able to come up with a plan or a strategy for ourselves in the future. Now, a question I get asked all the time is, how much money do we actually invest overseas? I love it. This actually came from Clem Santa, and he said, there's no right and there's no wrong answer to this, but he said that one needs to take your percentage happiness in South Africa's future and then you invest the rest offshore. So to use myself as an example, I'm probably 70 or 80% happy with the future and the fact that I will, stay in South Africa and my children will be able to stay, etc., etc. And so for me, I'm 70% happy with the future, and therefore I need to invest at least 30% of my money in offshore assets and offshore income. And I've actually, my portfolio is balanced somewhere along those lines. If you're only 50% happy in the future, well then you should be investing 50% of your money overseas. If, as many of our clients and some of our clients come to us, they've got no confidence in the future, well then they're externalizing huge proportion of their assets overseas, in terms of what's happening. And that's really where a concept we came up with called wealth migration. One of our clients actually said he wants to live in South Africa, but he wants to immigrate his money to Australia, and he wants his money to live in Australia. So it's just a funny way of looking at it, but we termed the term wealth migration. Your wealth is migrating overseas, but you are living in Africa, in South Africa, in the country that you love. Now, once you decide to invest overseas, who do you trust? Many of your friends and colleagues will have stories. I've told you over 80% of people lose money, and the problem is we get scared by these stories, and so we get analysis paralysis and we actually do nothing. And as I said to you, many of the reasons why people lose money is they invest with the wrong information in the wrong areas. They don't understand the purchase process, and people actually end up losing their deposits. They get wrong valuations. They get pricing misinterpretations. They have the wrong tenants or no tenants. I've given you examples. They've got cash flow problems because they promised one thing but it doesn't deliver. They've got maintenance problems on the building. They buy the wrong property in the wrong market, and I'm going to go into that in a little bit of detail. It's not just about investing in, say, London. You've got to buy the right property in the right area to be able to get the best returns, just as if you were investing in South Africa. They can't sell. If they do want to get out for whatever reason, they can't sell. And most importantly, I think as well, there's no customer service. And so people just get left with this massive problem and no one there to try and sort it out. So there's 5 critical things that you need to look for. And we've actually got a report, but just to show you, the first one is information. And one of the questions you've got to ask, and in this report, we've actually given you a whole lot of valiant questions that you must use. And no matter who you buy an offshore property through, you must go out and you must ask them these questions so that you can understand that you're getting the right answers, basically. So one of the things is, how much money do you spend on research? Every single year you should ask them, how much money do you spend? When you're choosing the right market, are there local investments? Are people on the ground there? And we've got a number of different questions. How often do you travel to that market? How often do you go yourself or someone from your team go and understand the market? Because markets change and you need to be able to keep abreast in terms of what is actually happening. Your partners or co-investors, how much have they invested? How much do they understand about the market? Are they just selling you something, or have they invested themselves? The rentals, there's a number of questions there to understand the rentals and make sure that it's not just a rental guarantee like in Dubai where they were promised 15%, but it wasn't market related, and that 15% was just topped up by the purchase price, and 2 years later the market related rental was 5%, and people took a huge smack because their cash flows no longer worked. The local and international offices, ask about the infrastructure, ask about their experience, and then ask about the after sales. And we've got a free report. Contact us and we can give it to you, but it's absolutely critical that you know the 6 things you need to know before you invest offshore. It used to be 5, we've increased it to 6, and the reason being is that whole deposit and how it works, particularly on off-plan developments, because it's absolutely critical and we wouldn't want anyone to lose money through not understanding that. So really get hold of that free report. It's an in-depth report on what you need to know to make sure that you get wealth preservation, a plan B, and peace of mind from your offshore investment. Now, let's go into the markets and let me explain them a little bit in terms of where we are. Now, the American market, we all know that the global financial crisis started with the American market, and I do believe that it's very important. I traveled extensively there in 2010. I wanted to go and understand what caused the global financial crisis. I want to understand where that market was going and try and understand where we were then going as international investors. And some of the things that I found absolutely fascinating. The very first one was what caused the subprime crisis. Now, I went and I asked people, and to get a mortgage in America, Literally, I asked someone, and he looked me in the face, and he wasn't joking. He said, all you needed to get a mortgage in 2006, 2007 in America was a heartbeat. Okay, and what they did is they did these fixed mortgages on 2 and 3 year fixes, and they had what they called ninja loans: no income, no job, no assets. They would lend money to anyone. And what they did is, and the guy would, or the lady would say, well, what happens after 2 or 3 years? And they said, oh, no worries, the property will go up in value and we'll remortgage the property on another fixed loan and you'll be fine. Well, what ended up happening was when the property market started to go sideways and even down, was that these fixed loans came to term, and that's actually what caused the subprime crisis. And you'll see this light blue graph here. This was the number of defaults on those fixed mortgages, basically. And you can see here it started to have a huge impact around 2007, 2008. This spike here was actually when Lehman Brothers went bankrupt. In terms of what was happening in the market and where we were. Now this graph is a little bit out of date in terms of what's happening, because we've now moved on all the way to 2012. But what was very nerve-wracking in terms of looking at this is that they also had securitized debt on commercial properties, but the fixes were longer, generally 5 years, and they were expecting it to really take heart in 2012. Now I know that the government's been working frantically behind the scenes. There's over $1 trillion worth of securitized debt in terms of the American property market, the commercial property market. But again, I'm not being a doom-monger, but I think you need to be aware of this. You need to know what's happening in the international markets, because it would have an impact both locally and internationally. And as an investor, you need to understand where the market's going and what is happening. Some of the other things that I think are fascinating is that what caused the subprime crisis in America is that from 2004, 1 in 4 homes that was built in America was unoccupied. Now, if we knew that, we would have known that they were going to get themselves into a huge amount of trouble. And 1 in 4 homes, and they actually got to a point where there are over 10 million homes oversupplied. 10 million homes sitting empty. Apparently, there's even further problems where the banks are holding back property. They call it shadow inventory. 7.5 million homes are held in that shadow inventory. And so there's huge amount of repossessions, but the banks also don't want to bring property onto the market because there's a huge oversupply in terms of what's happening with the property market. And that's why you can see this graph here. Here you've got the growth of the property market. It actually peaked in 2006 and then it fell dramatically. It actually fell over 50% in many markets around America. And then since 2009, April 2009, it's actually bumped up and down along the bottom in terms of where we are. Now, I do a huge amount of research, and I just wanted to share with you some of that research in terms of what is actually happening. So this here is a report, and I just wanted to read you, and again, you can get hold of me or you can go on our website and download these reports. But what's happening in America at the moment is investors wielding cash are revving up sales volume in the housing market. 31% of all purchases in December 2011 were cash deals. Bargain hunting drove sales of existing homes up by 5%. A steady pace of sales is critical in the housing market's recovery, of course, because we need to clear all those foreclosures and short sales off the books so that prices can stabilize and even start rising. And as I said, their problem is over 10 million properties are oversupplied. The problem with cash buyers is that they are investors and they put downward pressure on home prices even beyond the natural forces of supply and demand. The reason being is that cash buyers are able to bid significantly lower on many properties because they offer a shorter and more reliable closing time. That is music to the bank's ears, who are anxious to get distressed real estate off their books. This gives investors a big impact on the overall market than the numbers might suggest. Real estate agents say that investors generally offer 10 to 20% below the listing price on properties up to $250,000. First-time buyers as well as current homeowners are more likely to offer close to the list price. Investors want to close in 30 days or less, whereas other buyers need time with regards to getting mortgages, etc., etc., in terms of where they are. There was another report that I thought was very interesting here, which was where all the foreclosures are in America and what is actually happening. And just to let you know some of the facts and figures here, the neighborhoods boasting modern homes, cul-de-sacs, and tree-lined streets in and around the western cities now dominate the list of the top 100 US zip codes hardest hit by foreclosures and claim and compromise of all 10 of the top spots. In 2011, the western states claimed 82 out of 100, and the worst hit zip codes, 38 of them are in California and 28 of them are in Nevada. Nevada is Las Vegas. In June 2007, back then the auto industry's problems had turned the inner city neighborhoods like Detroit, Cleveland and Indianapolis into foreclosure ground zero, with 3 cities claiming 25 of the nation's hardest hit neighborhoods. Those older working class neighborhoods were particularly blighted, with vacant repossessed homes lining the streets. Nowadays, however, many of the worst hit zip codes are communities that were built in the past decade or two in and around once rapidly growing metro areas like Phoenix, San Bernardino in California and Las Vegas, the poster child of foreclosures. In fact, Las Vegas claims all 5 of the top 5 hardest zip codes in terms of where they are. And the problem with this foreclosures is that where you get foreclosures of more than 20 or 30% of properties in a suburb, it has a dramatic impact on the value of the properties. In neighborhoods like Orlando, there's 32,811 homes, in one suburb that are actually up for foreclosures. One 3-bedroom home in the area is currently listed for under $40,000. So that's roughly 320,000 Rand. But in 2005, that same house was sold for $120,000. Now, the interesting thing with that list price is that the estate agent says that it's probably a little bit too high and that it should actually be $29,000. So $29,000 when it was sold in 2005 for $120,000. In California, the average home price has been cut in half from December 2007. A 4-bedroom, 2,000 square meter, so that's 200 square meter home, was recently listed for $200,000, down 57% from the $465,000 that it sold for in October 2007. So hopefully that just gives you a good indication of what is happening in the American market. I do believe, and as I said to you, I spent a month there in 2010. I do believe I've stayed out personally of the American market for the last 2 years because there's massive risk with this oversupply, and it's all good and well to buy a property at a hugely discounted value. I mean, I looked at property in 2010 in Vegas that I could buy for $80,000, a nice 3-bedroom home, but in 2007 they were selling for $320,000. But the problem was 5,000 people a week were leaving Las Vegas in families, and so there was a huge oversupply of properties and there were no tenants. And so I decided not to invest because I believed the risks were too big. That same property a year later got offered to me for $40,000. But I do believe the tide is turning. I do believe it's time to start looking at the American market, and I'm going to go aggressively into the American market in 2012. But it's only going to happen based on the partners that I trust, and only when I have security that there is a tenant and an income stream in terms of where we actually are. In terms of the UK, there's a piece of research that I always use in the UK, and this is at the end of the day, there's a huge amount of research out there, but having been in the market for over 15 years, I know who the tried and trusted people are that I go and I do the research. Academimetrics, which is this company here, interestingly enough, they were founded by the Financial Times. They're not based on it. They don't have any initiative to talk up the market or talk down the market. All they do is they give you the facts and figures as they see them, and for me that is very, very important. And the interesting results, and this is the latest report which has come out, is that property prices rose 0.2% to £220,000 in December, but fell 0.5% annually. London, that's across the whole UK market. The London property values are 3.1% higher than last year, and Wales joins London as the only region to show an annual house price increase. Transactions fell in 2011 2.1% year on year, but the activity in the second half of 2011 was faster than the year before. And there you can see the average monthly change and the annual change. I want to read to you just a couple of other things that I think are important from this report, and again, you can get hold of me and I can send you this report. But the final month of 2011 saw modest rise in prices, which rounded off a year of economic turmoil in which property market showed remarkable resilience. Despite the growing fears of debt crisis in the Eurozone, prices rose 0.7% in the second half of 2011. With high inflation and reasonably static prices, this has helped make property more and more affordable. While transactions fell slightly in 2011 compared to 2010, the last 5 months of 2011 all saw high activity than 2010, boasted by an increasing number of buyers eager to take advantage of the most affordable market, even if it is very hard to obtain mortgage finance. Despite prices showing such astonishing staying power, 2012 is set to be another tough year. With the global economy in a powerless state, the size of mortgage advantage, which rose in the last 12 months by 3.5%, could begin to decline. The stamp duty holiday for first-time home buyers will end in April this year, which means a number of first-time home buyers will try and rush, but it's going to be interesting to see what happens once that is actually completed in terms of where they actually are. The 12-month story is that prices fell 1.8% for the first 6 months and then grew by 1.3% for the second half of the year, so that it actually lost 0.5% for the year. The property market for 7 months of the year actually increased, and for 5 months the property market fell. The current average price is £220,000, which is now £20,000 or 10% above the £200,000 bracket, which was in April 2009, which was the low of the trough, but is still £11,000 or roughly 4.9% off the peak. Now remember, this is the UK market as a whole, but one needs to take into account that the London market has actually been growing. Most will see real falls in price relative to inflation. If this in essence of 2011, then 2012 seems to be a repeat, with uncertainty once again dominating the picture. The market is not expecting base rates to increase in 2012, but unemployment will rise and supply of mortgage finance will remain tight. Expectations are that gross mortgage lending in 2012 will be lower than 2011, reflecting balance sheet reductions by some major lenders and the limitations imposed by the new retail funded market. Looking ahead, most expect that house prices to begin to recover and move ahead, reflecting the underlying and continuing mismatches between supply and demand. The fundamental difference between America and England is that America's property market decreased because of a massive oversupply. In the UK, the biggest difference that's happened in the UK is that there's still far more demand than there is supply, but people can't get access to finance, and that is the reason there's been a huge dramatic increase in the number of the drop of transactions. Although, however, none of this suggests anything exciting. The fact that the housing market has on balance performed well compared to the economy as a whole, it has shown considerable resilience, and subject to a sharp rise in interest rates or unemployment, it is not likely that anything is going to change in 2012. And then lastly, what I just wanted to show you, which I think is very, very important when trying to understand the UK market, and particularly London, is the number of transactions. So you'll see here, the average, the 10-year average is actually 100,000 transactions per month. It did peak during the boom years, but by the April of 2009, it had dropped to 26,000 transactions per month. It has increased now to about, well, the numbers here are yearly basically, but they are still 39% off the 10-year average in terms of where they actually were. And so that accounts for roughly 40,000 transactions per month, or over 400,000 transactions per year. And the reason being is that the first-time homeowners have left the market. Over 300,000 first-time home buyers off the long-term average of 500,000 per year have left the market in terms of where they actually are. So the biggest thing that's happened in the UK is this graph in terms of the housing transactions, and you can see that even though the press talks about how it's doubled since 2009, it's still 40% off the long term. And the biggest problem here is the mortgages. You know, in 2007 there were over 2,000 different ways to borrow as a first-time homeowner. Today there's less than 100. And also in 2007 you were borrowing at 5.5%, 6%, even when base rates were at 5.5%. Today base rates are at 0.5%, and you're still borrowing at over 6%. You know, so the banks are taking a huge margin. And also in those days you could buy with 100% financing. Now you need at least a 20% deposit as a first-time home buyer. They believe the average age of the first-time home buyer is now going to be around 43, which is the first time that someone can actually afford to save a deposit, because the average wage in England is £20,000 per year. If you take the average property price at £200,000, even a 10% deposit is £20,000. A 20% deposit is £40,000, and when you take costs into account, literally it's going to take them a huge amount of time to save that. But for an investor, it provides a fantastic opportunity in the buy-to-let market, because more and more of those first-time homeowners actually come in the rental market. And for someone like myself that only focuses on the London market, as long as you understand that capital growth, nothing fantastic is going to happen, you can buy very good properties with good yields, and there's a strong rental demand. And with the supply and demand out of kilter, not like America, not like in Ireland or in Spain or in Dubai, where there was a massive oversupply, in England, and this has been shown by London, where there's a huge demand, and the supply is not delivering. The market has already recovered and will continue to recover. And then lastly, there's 7 different indices in England. You need to be very, very careful, because different people talk them up and talk them down. As an example, Nationwide is the biggest lender. It's the equivalent of ABSA in South Africa, but less than 50% of properties in England are actually mortgaged, so I don't believe it's a very good indicator, and the press love to use them in terms of talking up and down the market. I like to use the Academimetrics, which is this pink one. They're the most balanced. They take it all off the deeds registry, so it's every single property that is transferred in the UK, and you can see here what has happened with the market over the last 12 months in terms of where you actually are. And then lastly, a graph which I think is pertinent. Over the last 12 months, London is the only property market to have shown growth, and again, from a yield perspective, it's the same. That is where the demand is in terms of what people are looking for. And then our last market of expertise is Australia. Now again, there's some fantastic research with regards to Australia, and I just wanted to share that with you. Again, we use an independent company called rpdata.com. They're an independent bureau. They again are not worried about talking the market up or down. All they want to do is present the facts. And just some of the things that I think are very important here is that they've had 2 interest rate decreases. So Australia was the first, well, just to talk it back, in 2008 when we hit the global financial crisis, they dropped interest rates from 8.5% to 3% over the space of 4 months, a 66% drop in interest rates. So they were very clever because they did that. They also brought in the first time homeowner allowance. The market stabilized very quickly, and from March 2009 it actually grew. It never really lost any value, and in 2009 it actually grew by 8.6%. Because base rates were so low, what happened is the property market started to heat up. They had a very, very hot year in 2009, and because of that they were worried about inflationary pressures. The economy also recovered because the Australian economy is very well run, and so it wasn't nearly as badly affected as America and England. They didn't have any debt. They actually went into the global financial crisis in a surplus, and so by doing that they were able to put stimulus packages and stuff in place. And so they were actually the only economy in the G20 not to go into recession. The G20 are the top 20 countries in the world, but they also were the first economy to put up interest rates to try and they put up interest rate 8 times over the space of 2010, and that, like any country in the world, when they put up interest rates, hampered growth in terms of what was actually happening. They do have a problem similar to South Africa, though. If interest rates are high, then people from foreign markets will bring their money into the country, and that will increase the value of the Australian dollar. Now, their biggest GDP is mining and resources. So just like South Africa, they also want to remain competitive, and they don't want their Australian dollar being too strong. They also had obviously the concern, with regards to the economy and the Australian dollar being too strong, and also where the future of the world markets are going. So in November they dropped their interest rates by 0.25%, and in December they dropped it again by 0.25%. So they've dropped it a full 0.5% in terms of where they actually are. And because of that, you can see the headline here: the rate cut triggers first rise in home loans home values since December 2010. Australia's capital home values rose by 0.1% in November. So it's not a hell of a lot, but the curve is now going in the right direction. And it's the first time it's increased since December 2010. The interesting thing is that over the year to November 2011, regional house prices are off minus 2.6%. And if you look at it as a whole, the capital markets, they break up the capital markets and the regional markets, and the capital markets year to date are off minus 3.5% in terms of where you actually are. Including gross rents, the total return realized by investors in capital city property remained positive in 2011 at 1.2%. And what's very, very interesting here is that the director, Christopher Joe, goes on to say over 90% of all Australian home loans are fully variable rates, and lenders have passed on most of the 0.5% percentage points worth in RBA rate cuts during the final 2 months of the year. Borrowers can now get fixed rate loans at 5.9%, and they expect house prices to start rising again in 2012. So Australia tended to be against what was happening in the rest of the world during the global financial crisis. As I said to you, they never actually lost. In 2009, they grew by 8.6%. In 2010, they grew again. But in 2011, they dropped slightly because of the rising interest rate cycle. And just like any other market worldwide, when interest rates rise, it tends to slow the market, and in Australia's case, actually even caused the market to go into slight decline. The interesting thing, though, is that you really need to understand the market. There's some very important components to the market that one needs to take into account. The first one is that you need to be regional. So here you can see the graph of what has happened with the Australian market, both in terms of capital growth and in terms of where the market has declined. And you can see here in terms of what has actually happened, there you can see the growth and how it's declined. This is just the growth averages and whether the property market was growing or whether it was declining. The other thing that was very interesting is that you've got to be regional. In South Africa you can talk about the South African property market, and that's great, but generally what's happening in Joburg is happening in Cape Town, whereas Australia is very regional. Perth can be booming while Sydney is busting. Brisbane can be going sideways while Melbourne is really growing. And so one has to have a huge amount of knowledge. It's a huge country, and you've got to have a huge amount of knowledge to what is happening in the different cities and where the different opportunities are. And something that I think is very, very interesting is that if you look at this graph, you'll see here that Brisbane has lost minus 7%. But the second thing that's also is you've got to be very specific when it comes to property. If you take Brisbane into account, the Gold Coast, which is the equivalent of like Natal, you've got Durban, you've got the South Coast, and then you've got the North Coast. The Gold Coast has had a huge oversupply. There's been a huge amount of foreign investment. There's been very little demand for tenancies, and foreign investors have battled to get financing. And particularly in the expensive market, properties have lost over 50% of the value. That's in the Gold Coast. On the Sunshine Coast, which is like the Ballito and Umhlanga, properties have lost 20 to 30% of the value. And that gets accumulated with Brisbane. So in the Brisbane CBD, the mom and pops houses, they have not been affected as dramatically, although the floods had a huge effect at the beginning of 2010. But the interesting thing for me is that 20,000 homes were affected by those floods. And rather than the builders being able to build new properties, they've had to go back and repair old properties. So my belief is that over the next couple of years, in the short term, the economy has been very badly affected by the flood. But in the medium term, whenever supply and demand is out of kilter, it's good for capital growth in the long term. And this is experienced by the rentals. The vacancy in Brisbane is less than 1% at the moment. Literally, that's the amount of time it takes for one person to leave and for another person to arrive. So there's huge potential. And also in these markets, there's great opportunity because you do have sellers. And they always say in property, the best way to buy property is from a motivated seller. You can see Perth is there. You've got Adelaide. You've got Melbourne. You've got, and there you can see Sydney. Sydney's literally status quo. Sydney and Brisbane actually are primed as the two major markets that people should be looking at, with the third market being Perth and the fourth market actually being Melbourne. But it's all regional. We helped a lot of people invest in Melbourne property. They were getting great yields in 2009. They've got great growth, over 20% growth on their investment in 2009. But it's about understanding the market. At the moment, we're not that bullish in Melbourne because there's an oversupply of properties in the CBD, and the rental yields are very low, so the returns on investment are not great. So one has to understand the markets, one has to stay with the markets, one has to understand and do the research in terms of the population growth, the infrastructure growth, and what is actually happening, so that one can make the best decisions based on informed information in terms of where we're going. The second major thing that you need to know about about Australian property, and I've already explained it with regards to the Gold Coast, is that there's different markets. You know, during the global financial crisis, the Sydney market over $2 million actually lost 20%. In the Gold Coast at the moment, the properties that are the top end properties that are over $2 million have lost up to 50%. And you can see that with this graph. The most expensive properties were the most to grow, but they're also the most to drop. Then you've got the medium properties, and then you've got the most affordable properties. We like to stick in the bracket from $300,000 to about $600,000. The reason being is that is where middle income Australia lives. Middle income Australia earns $50,000 per year. They can borrow 6 times their earnings. So if they're a one income family, they can borrow up to $300,000. If they're a double income, which most Australians are, they can borrow up to $600,000. And interestingly enough, 85% of the population lives in that middle income. So you're targeting 85% of the population. And statistically, that is where you get the best growth, and it's also where you get the best rental returns. So that is where we focus, both in apartments in the CBDs and also house and land or plot and plan Australian family homes, you know, in the suburbs. It's where average Australia wants to live, and average Australia accounts for 85% of the Australian population. There is just one thing that I do think is very important with regards to Australia, is that I believe personally, I've just got back from Australia at the back end of last year from another trip, and some of our wealthiest, most sophisticated investors here in South Africa are looking to Australia in the long term. And the reason being is that if you were to take a view, a 30 or 50 year view, I believe that Australia will be in one of the top 3 economies in the world. And the reason being is that firstly, they've got a very sound economy, and that was proved by how they reacted to the global financial crisis, how quickly they moved, how they were able to stabilize their economy, and how they were the only G20 country not to go into recession. The second thing is that their economy is based on resources. They've got resources. They can take advantage of where they actually are and their geographical positioning. There was a report I read where geography used to be Australia's biggest problem, and now it's its biggest asset. To move coal from South America to China is 3 times more expensive than moving it from Australia to China. And so, South America can never compete with Australia, and I believe that that's a long-term trend in terms of the emerging markets, the emerging growth. And so, and Australia is very well positioned geographically for the future growth, the next 100 years in terms of where the world is going to grow. And the third thing for me that is very important is that in Australia, there's only 2 ways to get into Australia. You can either have the money or you got the skills. Now, interestingly enough, 1 in 4 Australians actually was not born in Australia, and 1 in 2 Australians, his parents was not born in Australia. So they're very much, a country of immigrants, but they only let top quality people in. They protect their country, and different to England. I lived in England for 9 years. Any riffraff could come in and live in England and go on the dole. And I, have this feeling that over the long term, England is going to follow the European empire because of their population and because of their immigration policies. And I believe that Australia is the complete opposite. Every person that goes into that country just gets stronger, and the country and the economy and the population, and unfortunately their sporting teams, just get stronger and stronger and stronger. So with Australia, there's a number of things that are very important, but you've got to have the knowledge and the research so that you can take advantage of the opportunities. Lastly, we don't do Chinese property, but I think it's something that is very, very important if you're looking at international property. They talk about in America, the oversupply of property was 10 million homes that caused the global financial crisis. Well, currently, I saw a report at the end of last year by one of the leading news agencies in Australia, and there could be as many as 60 million properties in China that are oversupplied. There's actually a report, and again, I can share this report with you if you are interested. If I go back to the researcher, sorry, I just need to go back to the research paper, but it's actually this report on China, and it said the numbers in China are grim. China's property bubble is heading for a spectacular burst, and its effect on the country's economy will be widespread. In 2011, the country grew by an impressive 9.2%. But the maths of the property market tells a different story. The housing frenzy has driven prices so high, so fast, that a crash on a scale of the real estate collapse in Japan in the 1990s is a virtual certainty. And China's already exaggerated official growth rate could take a pounding all the way to the zone of the unthinkable in low single-digit figures. In China, the housing boom is far bigger source of growth than is widely recognized, and it's totally unsustainable. A typical $600,000 unit was bought by a landlord, and they get $1,000 a month in rent, or a yield of roughly 2%. Now, the reason they're happy with a 2% yield is because they're going for the capital growth, where they're averaging between 20 or 30% a year from 2008. Now, anyone that's experienced the global financial crisis will understand that whether you're the biggest property fund in the world, or whether you one-man band property investor, those people that take and chase capital growth eventually get a hiding. It's been proved by the biggest property funds and by the individual investors. If you chase capital growth and capital growth alone, one day winter will arrive and you will find yourself with your pants down. And that is why it's so important to focus on income. And the whole basis of this argument is that the Chinese market is unsustainable with income at 2%, with returns at 2%. It basically means that property price are 50 to 60 times higher than their rental valuations. And even at the peak of the American market, it was only 40 times the peak. So with yields at 2%, if they were to normalize back to roughly 5%, which the yields in Australia are 5%, the yields in London are about 5.5%, the yields in America are roughly 6%. So if they would normalize just back in that time, it means that the prices would have to decrease by roughly 60%. 60% decrease in Chinese property. Now, when you take a 60% decrease and the fact that properties are oversupplied by up to 60 million properties, the problem is that these properties are completely unaffordable. Everyone says is that, you know, that it's something like 1 million people a month actually join the Chinese middle class, and that is what's causing the growth of the economy. But the problem is they can't afford these expensive property prices, and so those people that bought property in 2007, 2008 are currently experiencing losses of up to 30%, where developers are selling it for literally 30% of the price. The reason, and if you want to understand what has happened with the Chinese market, is that basically, why did they get such a good growth rate? It's important to recap the forces that caused this frenzy. Chinese imposed tight restrictions on returns on bank accounts, government bond yields, and other domestic investments. Inflation for 2011 exceeded 5%, but 10-year bonds were only 3.5%. It's extremely difficult to find investments that yield more than inflation. When the easy money policies took charge after the worldwide crash in 2008, the excess cash flowed into the only place with big returns, and that was real estate. For around 4 years, China has been building 1 billion square meters of housing a year, 10 times the figure of the US. The amount needed to accommodate the real owners, people moving from the farms to the cities, is roughly 700 million square meters. So let's assume that the demand goes back to level. China is also swamped with 7 to 8 million vacant units. So there's different reports. Here it's 7 to 8 million. I've heard as high as 60 million. But let's be conservative and say 7 or 8 million. If around 2 million of those are sold a year, China will need to build just 500,000 square meters annually, half of the total over the past several years. The decline will pound not just expenditures on apartments, but on production of steel, copper, and appliances. Housing production could lower Chinese growth rate by a full 5 percentage points, and it literally could come in to around 3% growth for China. And what he went on to say here is that China's spurt of a 10% growth is likely to be history. So, I personally won't be investing in the Chinese market. I believe that supply and demand is the most fundamental criteria that one needs to look at. But in terms of world growth, I think it's very important to understand what is happening in that market, and certainly it could have an impact worldwide on the economy and even on resources, which is something that you'll read about in my market reports, is one of the risks that face certain countries, certainly South Africa and Australia, that are high resources based. People always ask me to compare between the different countries. Well, you've got Australia, the UK and America, which are the three primary offshore investment destinations. The Australia's had an economic shift to China and is a growth economy. It's got no debt. In 2012, the GDP growth, according to the IMF, the International Monetary Fund, is 3.3%. The average property growth is for the last 100 years is 9%. The average growth during just after the global financial crisis was 8.6%. Last year was minus 2.6%. I believe the risk is really low, and that's because the supply and demand fundamentals are so out of kilter, and there's such a strong rental market that even if the market was to decline slightly, you can ride the wave and rely on your rental returns. And the opportunity is average. At the end of the day, it's a very sophisticated market. There's not that much motivated buyers. Interest rates haven't spiked dramatically, and so there's average opportunities. The UK is come out of a recession, but it's got European troubles. It actually come out of a recession, but now there's talk of it possibly going back into a recession. Its debt is £910 billion. Every single kid that is born in England is born with £35,000 debt over their head. The GDP growth, according to the IMF, is 1.6%. The average property over the last 100 years has been 9%. It lost 15% in the global financial crisis, and last year, even though it started to recover in 2010, last year it lost 0.5%. I believe the risk is average, and that is very much, even though the supply and demand factors are in its favor, and particularly in London there's a lot of rental demand, it is very concerning what's happening with the contagion debt in Europe and the impact that it'll have on London. And the other thing that I think is very important is that 70% of the GDP of England is based on banking and insurance, and at the moment Cameron and his government are going after the bankers, and it's that whole thing of don't kill your golden goose, and it's very easy for bankers to move to Switzerland and to Dubai and Hong Kong, etc. And there was a huge article in The Economist on the impact it could if they chased the banking industry away, and that's obviously, there's all the support staff, and they are the tenants. They are the ones, particularly in London, that are driving that tenant demand. So that's where the growth lies, and then the opportunity is also average. The reason being is that they're good opportunities, but because the interest rates are only 0.5%, there's not very many motivated sellers that are being forced to sell. In America, it's in a growth phase, but there are structural problems. The debt is 14.3 trillion, and in fact is actually pushing now over 15 trillion. As you know, America officially went bankrupt in August, but they managed to get more debt. The growth is 1.8% in 2012. Their market lost up to 40% across the entire market. In 2011, there was no growth. It just bumped along the bottom. And the risk in America is very high. There's huge risk. And again, when I went and spent a month there in 2010, I decided not to buy and thus not to recommend to my clients because of the huge risk, because of the huge oversupply, and because I couldn't be guaranteed tenants. But I do believe the opportunity is great as well. If you can buy the right property at a third of its value or 50% of its value, and you can buy and get a tenant, then really it can add a lot of value. And I've got a good friend that's bought a property there. He actually remortgaged his house in South Africa, bought the property for cash in America, and it's cash flow positive, and the rand is actually devalued by 18% against the US dollar. Effectively, his yield has gone up by 18%. So based on that, and watching the market, I believe it's time for us to aggressively go into the market in 2012. Now, a number of concerns that our investors often bring up, and I'm going to just focus on Australia here, but we've got solutions for England as well, and we won't launch America until we're happy with the solutions there. But I want to go to Australia to choose the right investment. As I said, a lot of people do panic purchases and fly over to Australia and arrive in Sydney. They have 1 week and they try and buy something. Well, as I ask, what type of research do you do? We've actually got a filter system. It's a 100-point rating system where we work with our partners partners on the ground, and we look at things like population growth, employment growth, capital growth, overall development analysis, property individual analysis, property project conclusions, infrastructure, rental market, area demographics, investment affordability. And it's a 10-10-10 system, so we actually rate different projects. We rate them based on the area and all this, and based on that rating is how we actually, coordinate and decide for good investments. We also understand what's happening. This here is a plan, the Melbourne 2030. Now, you might arrive in Melbourne and go out and try and buy a property, but you're not going to be successful unless you know the population growth, unless you know the infrastructure growth. And this is actually a plan. The thing in Australia is that they're very well structured. They don't go out and build homes like we did in South Africa and then realize that there's not enough electricity, not enough roads, not enough water, etc., etc. What they do is they plan the cities, they plan the infrastructure growth, they plan the population growth, and you can actually see here in Melbourne that they're planning the growth out to the west, in the northern corridor, and in the southeastern corridor. And this is where all the infrastructure growth's going, where all the shopping centers are being built, where the schools are being built. And it's only, it takes common sense to realize that if you're investing in the high growth areas, that is where you're going to get the best returns. And in all the cities in Australia, they've got these type of reports, but you need to know where to find them. And this is why we spend millions every year on research, so that our decisions on investment are not just based on gut feel, but are actually based on tangible research, so that we can make educated and informed decisions. And here again, you can just see Melbourne and the growth corridors and what's actually happening, and all these reports in terms of where they are. The second one, I'm worried about management and maintenance of my investment property. It's so far away. What can I do if there are any problems? There's an Afrikaans saying, and I'm from Durban, so please bear with me, but ver van jou skut nara on your skada, where people are worried when it's a long way away, how do you look after it? Well, most importantly, I started investing overseas. I bought my first property in 2000. I understand all the challenges and the problems of investing long distance, and because of that, that is why we provide a full end-to-end solution, including management solutions. And as an example, one of our partners in Australia is a company called Ozinvest. They've been helping people in the Navy, in the Army, who are also a long way away from home, or even investors that are buying in Brisbane that live in Perth. So they understand the complications of investing over, a long way away from home, and so they have a full management and maintenance solution. And whoever we partner with in any of our investment destinations, it has to come with a full management and maintenance solution, so that your property is looked after, because we are aware that you can't pop over and go and fix it like you can in South Africa, but neither can the Australian investors, and certainly neither can the Defence Force people, who the whole company was based around when it was formed in 1987 in terms of investing overseas. What happens if the tenants don't pay my rent? How can I afford my mortgage? Well, again, this is where you've got to do significant research, know where the rental demand is coming, and depending on your risk profile, there's areas where there's very low vacancies, huge amount of demand, or even we've got the 10-year lease back, which is actually where your rent is guaranteed. It's paid on the 10th of every month. We've had a huge amount of South Africans that invested in this very happily, because they can do their cash flows. They know exactly, what they can expect. They get their rent paid each and every month. This is not a rental guarantee. It's basically an economies of scale. They've got over 1,000 properties under management, and they charge $18 per week. And because of that, with 1,000 properties, they earn $18,000. So it equates to less than 2%, but it's like an insurance policy, but it gives you the peace of mind. And the beauty is that you actually sign your rental agreement before you buy the property, so you know exactly what you can expect. It gives you complete transparency. And then, how do I get a mortgage, and what happens if the interest rates go up? Well, we help you. We provide an end-to-end solution. We've got people based in both the UK and in Australia that specialize in helping South Africans get mortgage. Our partner in the UK has helped over 1,000 people get mortgage, and to be honest, it's hell of a difficult. And in 2011, we had to go to places like the Bank of Cyprus, the Bank of Nigeria, but we'll do whatever it takes to help you get a mortgage. And in Australia, we've actually got a gentleman called Mornay. He's a South African that's been living there for a number of years. He can speak Afrikaans, and he's provides our clients with a fantastic service, understanding what they're looking for. But it's very sophisticated and very structured in Australia and in the UK, so we need to understand what your requirements are, and then we have specialists that help you do it. And as an example, if you're worried about interest rates going up, you can actually get long-term fixes. You can get 2-year fixes, 5-year fixes, or even longer-term fixes that can give you that peace of mind. I'm thinking of moving to Oz. Should I buy before I move, or when when I get there. Surely it's easier when I get there. Well, there are 4 things that you need to know. The first is that property in Australia is very tax efficient. So even if you've got a shortfall, so you know in South Africa you've got a mortgage that's costing you 10,000 Rand a month and your rent is 6,000 Rand a month, that 4,000 Rand is, there's nothing you can do about it. It's Section 21 of the Tax Acts and it's ring fenced. Whereas in Australia you can accumulate that, you can depreciate on the construction, you can depreciate the fixtures and fittings, you can take a portion of the acquisition costs, and you can even include 1 inspection trip per year. So if you fly over to Oz once a year, you can include the cost of that in your depreciation. So every year, even though it's not costing you any money, you're actually getting a tax deductible allowance of $6,000. Now, if you move to Oz in say 5 years' time, you can accumulate that tax loss, and you can accumulate a tax loss of $75,000 or $100,000, and you don't pay a cent, you know, when you move to Oz in income tax until you've actually paid off your accumulated tax loss. If you never move to Oz, the nice thing is you can offset it against your capital gains tax. So I always say it doesn't matter if you bet on red or black, you win both ways. The second thing is immigration. There's 3 ways to immigrate into Australia. You can either go in on a skills-based visa, you can go on a business visa, or you can go in on a buy-your-way-in visa. Just interestingly enough, on the skills-based visa, it doesn't really help you with property, but you must be aware that it's changing in June 2012, and it's no longer going to be a case of just qualifying. It'll be a bit like trying to get into university. It's not just about qualifying, it's about being one of the top candidates so that you can actually get a place. The business visa is how most of our clients go in. There's 3 criteria. If you've got a business in this country and you can prove that you've had a turnover of more than 2 million Rand for the last 3 years, then you will qualify. There's 3 things you need to do. You need to invest $250,000 in Australia. You need to move to Australia and live there for 2 out of 4 years, and or you can employ an Australian citizen. And so you've got to do 2 out of the 3. What most of our clients do is they buy 2 properties, which is more than $250,000 in terms of the cash invested, and then they go and live in Australia, and with that they get their business visa. And the last way is the buy-your-way-in visa, where you invest $750,000 and you literally buy your way in. But again, owning property, it shows your initiative, it shows your willingness to invest in the country. It doesn't guarantee you citizenship, but it certainly enables it. Your credit rating, the only way to discuss this is to be able to give you a personal story. I lived in London for 9 years. I came back to South Africa. I had no problem getting a cell phone and car finance. And the reason being is that I had a number of properties in South Africa with my rent coming in and my mortgage going out. My uncle, I've already told you about him, but he basically moved to Brisbane. He bought a property for $1.2 million cash. And yet for a year, he couldn't get a mobile phone contract, he couldn't get car finance or any credit cards or anything because he didn't have a credit rating. And so we believe, you know, it's very important to have a credit rating overseas, and particularly if you're thinking of moving somewhere. You know, I always say to people, start living before you leave, start building up that credit rating. And then lastly, and without sounding chauvinistic, a number of females get concerned because they say, well, that's not the exact property I want to live in, that's not my home. It's not about buying your home now. It's about buying the property that's going to get you the best return on your rands and cents. When you look to buy, I always believe it's very valuable to rent for at least a year so that you can check out the market, you can understand it, you know what suburb you want to live in, but you know where the golf course is, where your kids are going to go to school, where your friends are. And I don't believe that you can do that from long distance. So we highly recommend renting when you go over. And while you're doing that, if you own investment properties, you're getting the best return on your rands and cents. When you're ready to buy your dream home, get in a car, go with an estate agent and find your dream home. And what a number of our clients do is actually remortgage their investment properties, because now that they're living in Oz, they can take their loan to value from 70% to 90%, and that 20% they can put down as a deposit on their home, or they sell one or two of their investment properties and they can pay off their property. So really, for me, the investment properties actually facilitate you buying a home when you're actually ready. Another one that a lot of people ask me, if it's so good in Oz, why is Australia or others, or Ozinvest, actually coming out to South Africa? That is not the case. In the same way that I'm going to be flying to America in the next couple of months, with our 15 years experience, we actually go out and we find our partners on the ground. We believe that our strategic partnerships with our best of breed partners is one of the most one of the things that we're proudest of, basically. We find the best players in the market. We find the players that are delivering the best solutions to local clients, and then we partner with them. And so Ozinvest didn't come to South Africa. I went to Australia and actually found them. We've done the same in the UK, and it's one of the reasons why I need another trip to America to find best of breed partners on the ground that we trust. And what we're basically wanting to stop is what's happened here. You can see this report here. South Africans are big game hunting on the Gold Coast, leading to 3,900 splurge in foreign investment. And unfortunately, many of those South Africans have been seriously burnt buying on the Gold Coast because, developers and estate agents flew out to South Africa, held big road shows in hotels, and sold them crap, basically overvalued crap. And unfortunately, it's even in the newspaper in terms of what is actually happening. A question that a lot of people ask me: my brother lives in Perth or Brisbane or Melbourne, shouldn't I look there? We're not interested in where your brother lives. At the end of the day, it's about getting you the best return on investment. You need to know what's happening in the markets. You need to know what type of property to invest in. We are interested in the numbers and the returns. And for me, we've got a full solution in terms of management and maintenance. So it's about the research that's going to help you make the best investment. Why should I do it now? Well, I've given you a number of reasons with regards to the timing and what is happening, but the most important thing is that there's good opportunities, great value opportunities, capital value opportunities, and the rand is strong, and it provides you with an opportunity to manage your variables now in terms of what you're doing. There are lots of companies. How do I choose? Well, that's where we've created that report on the 6 things you need to know. We don't mind who you use, but please make sure that you ask them the pertinent questions so that you can make educated and informed decisions, and you don't join the 80% of people that actually lose money when they invest overseas. And then a question I get asked all the time, surely it's cheaper if I deal with a company like Ozinvest directly, or even if I fly to Oz or London and buy from someone directly. That is never the case. We actually negotiate deals. We work with our strategic partners on the ground, and we actually work on a 50-50 basis where we split the fees and the commissions 50-50. So it's a value for them because we're in this market and we can deal with you on a face-to-face value and can really help you right through the process, and it's a value for us because they're on the ground and can help. So there's complete transparency, and in countries like Australia, you can actually go to jail if you overcharge with regards to property in terms of where we are. So we're very nearly coming to the end, but I just wanted to give you some examples of the type of properties that clients have invested in over the last 12 to 18 months. This here is in London. It's in Canary Wharf. This building here is called New Providence Wharf. There was actually a buyer or a seller that got into trouble. He was a motivated seller. He had 26 properties that were going into liquidation, and we helped a number of clients buy, and it was a beautiful existing building. They got it at a great value and good yields, and literally on the doorstep of Canary Wharf. This here is a property in Earlsfield. And that's in southwest London. It's right next to Wimbledon. It's between Wimbledon and Putney. And actually, we've got a partner there who they help young South Africans, Aussies, Kiwis, Canadians come over, and they actually sign a long-term rental with you so that you're guaranteed your rent each and every month. And then they sublet the property out to these youngsters that come and they stay in the property. They take care of the management. They also take care of the maintenance, so it's not your concern. And this is a nice period home, in Earlsfield, so you'll get good capital value over the long term, but you've also got security of rentals, and we only focus on London because we believe that's where the market is. This here was a medical center. I traveled over with one of our highest net worth individuals, one of our most sophisticated investors, and we looked at a medical center. This was in Bondi Beach in Sydney, and it was very, very positive. It's the reason we got on an airplane and flew all the way over there. But when we looked at it and interrogated it, and with my partners who are very sophisticated commercial investors, they've made all their money here in South Africa through commercial and residential property, we found that the 15-year lease with a blue chip tenant was actually a 5x3 lease, and so there was significant risk, and so we actually didn't necessarily go ahead with it, but we did a huge amount of due diligence on this, and these are the type of opportunities that we are looking, and particularly, medical centers have a very good return, and one of my partners here is actually an expert in medical centers. But we also looked at this opportunity. This was in Sydney. There's a 10-year lease with New South Wales University, or the University of Sydney. So a very blue chip tenant. The property as a whole was a $32 million investment with a yield of 9%. And the beauty is we needed to put in about $7 million. The existing owner had again got themselves into problems with loan to value ratios. Their loan to value ratio was 82%, which the bank is not comfortable with. And so they wanted to recapitalize, and by putting in $7 million we could actually buy 50% of the company. We were guaranteed a return of 9%, and then we had the upside and the capital growth. And we did significant due diligence on this just before Christmas 2011. We have continued with it, but the challenge was that we were up against it to try and finalize this before Christmas. But a fantastic building, fantastic location in Sydney, and very much going after a very popular, very successful market in both England and in Australia with the student accommodation. We've got shopping centres, we've got commercial opportunities. I've actually got a South African guy on the ground in Australia and in England that provide us with opportunities. So it's very much a broad mix, but these are bespoke opportunities that I wanted to give you an example. This is more popular amongst many of our clients. This is a 4-bedroom, 3-bathroom home in Brisbane in the suburbs. And you can actually see a double garage, and this is one of our South African clients. He's very, very happy with his property in Brisbane, and this came with the 10-year lease back, so he gets paid his rent every single month on the 10th of the month. He knows exactly what it is, and then every year with rental escalations he gets to improve. So very popular amongst our clients. This here was a development called 8 Mile Plain in Brisbane. It's right on the infrastructure route. There's a rapid bus transport that goes in. Very popular amongst younger people now. They wanting to live in higher density, closer to the city, and one of our investors, or a number of our investors, actually invested in this because of its strategic location. And this is actually an off-plan development that's currently being built. They are so confident, our investors, in the Australian market and the Australian residential market, that they were actually one of the seed investors that bought the land for this development and have invested millions of dollars, not rands, millions of dollars in this project, because, and they're South Africans that have been investing in Oz now for over 4 years, but they are very bullish in terms of the Australian economy, and if you're in the right sector of the Australian property market, where it's going. And it certainly gives me a lot of confidence and a lot of faith that billionaires from South Africa that have made all their money in South African property are confident about where the Australian market's going and are investing millions of Australian dollars in projects. This here was a very, very popular project for our clients, Station 16. It's just on the other side of the river from Brisbane, literally 800-meter walk across the bridge. It's right near the South Bank, which is where the convention center is. It's where all the shops and the restaurants are. You're right in the vibe of the city. And, you know, in the old days, people wanted to live in 4-bedroom, 2-bathroom homes, and they still do with families. But it's becoming, for the younger, you know, professionals, it's all about hip and trend now and being close to the city. And you can see here, this development, and that's the views out over the Brisbane skyline, and literally you walk down this road and then across the bridge, and so it's right in the heart of the city, and very, very popular investment for a number of our clients. And then just with America, we don't have anything on show at the moment, but it's certainly something we'll be launching in 2012. And these were just pictures I took from my last trip. This was a house that I looked at in America. It was a lovely 3-bedroom home. This was the one that was actually $80,000. That used to be $320,000, but it was a foreclosure, and there were literally signs here of people trying to give away their homes at $39,000. It was a picture that I took that was on a signpost. As I said to you, there is huge opportunity in America, but there's also huge risk, and so we're working with our partners over there. And as soon as we get confidence in both the product and, most importantly, in the fact that there's a management solution and that there's a rental stream that we can rely on, then it's something that we will be looking at. That will be slightly higher risk, but with better returns in terms of where we are. Okay, and then I've spoken a lot about returns and cash flows and what is going on, but for me, you know, this is the most important document. I'm not going to go into this in detail. I believe it's important that you can go through this in a meeting with one of our offshore property consultants, offshore specialists, but you know, you can actually see here we've got cash flows. We take you through all the numbers. We don't like surprises. You know, everything, we update this. We've just recently updated it now in January with any new changes or any new fees or or costs that come out. Everything is put here. You've got all the variables up the top with all the explanations and what it actually means. Then you've got the capital outlay that you're looking at. You've got the amount of money that you would need. You've got the cash flow, your P&L. And what you can expect. You've also got what happens if interest rates decrease or what happens if they rise with different scenarios. And then you've got capital growth rates and what the expected returns are. And this is your dollar return and this is your rand return, taking into account devaluation of the rand and taking long-term projections. It really helps you to be able to compare apples with apples. And I believe from an investment perspective, it's all about the numbers that are the most important. This here is a movie, so it gives you an idea of where this property goes over the next 25 years. You've got the tax situation, and then you've got the breakdown of all the costs and what is actually included. So, I'm not going to go into this in detail because it takes quite a lot of time, and I'd far rather, myself or one of my team actually go through it and explain it to you. But it's very, very important for you to understand, the full picture of your investment from a cash flow point of view, from a returns point of view, and where you're going to be over the next 5 to 10 years. It gives you a great idea in terms of your investment. So in conclusion, the question is, you can either do it on your own or you can work together. But nature's laws are that things work more successfully when people work together. Flocks flying with 25 birds or more can actually fly 70% further than flying on their own. So you could get on a plane and fly to London or fly to Sydney and go and invest overseas. You could try and do it on your own, but unfortunately the stats are against you. Over 80% of people that try and do that lose money. And we would highly recommend that you partner with people that know what they're doing, that have best of breed partners on the ground that specialize in those markets. And by doing that, you will be able to get wealth preservation, a plan B, and peace of mind. If you don't mind, I want to tell you just a little bit about ourselves and where we come from. We're International Property Solutions. We were founded in 2003. Since then, we've helped over 2,000 people invest in international property. We've only ever done international property to a value of over 1.6 billion. As I said to you, we focus on international investment. It's our niche, it's our stronghold, and it's what we're experts in. We have offices in South Africa, Australia, the UK, and America, and so we've got a global platform. We spend millions every single year on research, including multiple trips to these markets, from someone within our team to make sure that we're happy with what we're finding. We've got best of breed partners in specific countries. I believe it's our greatest accolade, and I believe that it's one of my gifts after 15 years of experience, and that's actually choosing partners that can deliver and provide the best solutions. And that's both been through pain and pleasure, also learning what doesn't work. We've got a very sophisticated IT platform providing efficiency and transparency for both our clients and for the sellers in the foreign markets. We've got a very experienced after-sales division, who've been part of the team for many, many years and are experts on the Australian processes, the UK processes. And again, when we launch Australia, we'll partner with people that are experts in those processes so that we can hold your hand right through the process. I always say we can't make all the problems go away, but we can certainly hold your hand and make the journey as smooth as possible. We've got access to off-market opportunities, so these are things that aren't even on the market, by having the right relationships. And something that I think is very important, there's an international worldwide organization called AIPP, which stands for the Association of International Property Professionals. It runs out of London, and we were the very first South African company to be invited to join that group. It's a whole application, and we applied and got accepted back in 2007. So we were the first South African company. I'm not sure if anyone else, but this is an organization that holds us in international property, like the Estate Agents Affairs Board or the Institute of Estate Agents holds estate agents accountable in South Africa. This is the only body internationally that holds us accountable internationally, and I think it's very important that whoever you deal with is a member of that organization, because it holds us to a higher standard and makes sure that we're delivering on the promises and that you are getting the best investments internationally. My story in terms of International Property Solution, I did explain to you why I invest overseas. I explained to you why I created an international company. But in 2000, I bought my first property. I was living in London. I bought my first property back in South Africa, and it was an absolute nightmare dealing with estate agents and lawyers and banks and mortgage brokers. And so I thought there was a real need to provide a service to help people invest internationally. And so in 2003, at the age of 26, I resigned from my job and I actually set up International Property Solutions with a specific focus on helping people invest internationally. And to date, we've dominated in 3 markets, the South African, the Australian, and the UK. But as I say, watch the space because we're going into the American market. And having experienced invested in international property myself, I know the pitfalls, I know the challenges, and that is why we find the partners so that we can provide you with an end-to-end solution. And our slogan is actually invest with confidence. We provide you with the research, we provide you with the partners, we provide you with the information, we provide you with the experience so that you can make the right decisions. And the value that we deliver is wealth preservation, transparency, value creation. We're great communicators through using IT technology. We believe in getting good returns. We have a conservative approach. You know, people that are moving their money overseas are looking for wealth preservation. We're looking for risk mitigation, you know, moving away from malema proofing or whatever you call it, but some of the risks that exist in Africa, we provide people with a plan B, and then we provide them with peace of mind. And so, you know, the next steps, if you are interested, we will send you an email with a link to a survey. Please fill in that survey. The more information that you give us, the better we are able to assist you. You know, there's 2 ways that this relationship can work. We can play poker where we keep our cards close to our chest, and if that's the case and you don't trust us, we're not going to be able to assist you. But if we have an open relationship, like when you go and see your doctor, you tell them all about yourself and what your problems are because you trust your doctor, well then your doctor can provide you the best advice and he can help you and provide you with a solution. If you fill in the survey, we are only prepared to help you if we can go into the doctor's approach. So you can fill in the survey, you can tell us what your problems, your concerns are, what you're looking to achieve, where you're looking to achieve it, and then we can really help you and provide you with a solution. We then need to set up a meeting, and one of our offshore property consultants they are experts in their field, and they will come and they'll sit with you, and once they understand where you are and what your concerns are and what you're looking to achieve, they can then come up with a bespoke solution which is tailored just for you and can provide you with what you're looking for in the long term. We'll then help you choose a property, we'll help you with the finance and getting a mortgage, we'll help you with your exchange control approvals, we'll help you manage the entire purchase process. So dealing with the lawyers, the FIRB, which is the Foreign Investment Review Board. In Australia, you're only allowed to buy new properties. So you can buy a new apartment, a new house, or a new piece of land, but you can't go and buy off an old granny or someone who's getting liquidated. You know, if you're dealing with a developer, we'll deal with all the inspections. So before the property transfers, we'll actually send in an independent surveyor who will give you a surveyor's report to make sure that the property is up to the quality. So everything has been thought through and taken care of, right through to management. Will help you with regards to the management. And when people say to me, well, Scott, how are we actually going to do this? I always say to them, well, you know, Ozinvest are currently helping 40 Australian soldiers who are based in Afghanistan. And if 40 Australian soldiers who are living out of tents in Afghanistan can do it, then we can certainly do it living in South Africa in terms of where we are. In conclusion, I would like to say, whatever you do, you know, if you're looking for a plan B, if you want peace of mind, if you want preservation, then you need to take control of your tomorrow. We're not sure about what the future is going to hold. We're not sure if it's going to be good or bad. But as Clem Santa said, I highly recommend that you have a plan no matter what scenario plays out. And that is what I mean with taking control of tomorrow. We have the global knowledge, the local solutions, and the best of breed partners to provide you with a transparent solution to preserve and create real wealth through international property. And by doing that, you will have a plan B and you will have peace of mind for you and your family. You can see all my contact numbers which are up there. If you want to go to our website, or if you want to email me personally, there's our number based out of our head office in Johannesburg. There's our blog where we put up all our research. Twitter where we let you know the latest research and what is actually happening. This here is our YouTube channel, which is where I put up all my videos, and Facebook where we keep in contact. And in conclusion, I want to leave you with a little story. In 2009, I met 2 brothers. They were based in Durban. They were both Zimbabweans. They had already been through it once in terms of building up all their assets and their wealth and then having to leave Zimbabwe. And they moved down to South Africa in the late 90s. And once again, over 10 years, they built up all their wealth. They built up a company together. And I sat down with them at the end of 2009. And these two brothers, one wanted to stay in Durban and one wanted to leave. He thought that South Africa was going the same way as Zim, and he wanted to go to Brisbane. And I urged him before he left to go to Brisbane that he bought a property based on his South African income. And the fact that he had resources and he could put down his deposit now. He should buy himself an investment property, and even though it might not be the home that he wants to live in, go over to Australia, rent a property, have the peace of mind knowing that you're in the Australian market and that you can get going. And he decided not to. He decided that he wanted to just go to Oz. The other brother, he wanted to have peace of mind, and so he decided to stay in South Africa, but he also wanted a plan B. And so he started accumulating properties. And in 2010, he actually bought 3 Australian properties through us. And, you know, he said to me, every time Malema opens his mouth, he very comfortably sits there knowing that he's got a plan B, knowing that he owns offshore assets and offshore income, and knowing, you know, that he has peace of mind for him and his family, and that his wealth is being protected in first world assets and first world income. And unfortunately, it's not a very nice end to the story for the brother that didn't have a plan and that did a crisis decision. He went to Brisbane in 2010. He couldn't find a job because, you know, at the end of the day, he was an entrepreneur. He eventually plied through all his wealth and his assets. He couldn't buy a property because the bank wouldn't lend to him because he had no track record of earnings. And less than a year later, he had burned through all his savings and he couldn't get a job. And he ended up having to live in one of his other brothers' houses that he had bought. He still to this day has not been able to get himself on the feet. He doesn't own a home for his family. He doesn't own any property, and he's burned through all his assets. And so for the 3rd time in his life, he has to start from scratch all over again. You know, my question is, which brother do you want to be? Do you want to be that brother, or do you want to be the brother that plans? No matter what the future holds, he's got a plan. He's living in Durban. He loves his life in South Africa. He loves living in Africa, but he has a plan B. He has the peace of mind that should something go wrong, he has a plan in place. And at the end of the day, his wealth is being protected. And my logic is, the brother that invested in Australia from South Africa, he's taken care of all scenarios. And that is why him and I see eye to eye. I believe that it is not only prudent, but that it is downright, it is irresponsible if you don't have a plan for each and every scenario, both for yourself and for your family. So in conclusion, I hope that has been a huge amount of value to you. I look forward to meeting you one day, and really please fill in that survey, meet with one of our offshore property experts. They'll be able to take you through, they'll be able to understand where you're coming from, and most importantly, they will be able to provide you with a solution that can give you wealth preservation, a plan B, and peace of mind for you and for your family. Thank you very much for your time, and I look forward to meeting you one day in the future. But most importantly, once you've got those assets and you have a smile on your face. Thank you very much, and goodbye.